Welcome to the August 26, 2024 Advance Report from McGowan Group clients and NetWorthRadio.com listeners. He finally said it. Jerome Powell goes to the Jackson Hole, the famous Jackson Hole conference that's every year, and the Fed gets to speak and everybody was anticipating it. And he said, basically, it's time to cut rates. So September 18th will begin that. How would you have known that back in March? Well, that's why you subscribe to YouTube McGowan Group, because look at this. We covered this in March. This is what the Fed said in March. This is all the suits. The board members, Federal Reserve Bank presidents, they like to move as a group because that way if they're wrong, they did it as a group. And so they all do their projections. How are things in the economy? Where are they going to go? They told you where they were going to go back in March. Fed funds, March projection, they're going to just above 2.5% on the Fed funds rate. 2.6 from, at the time, 5 1/3%, which is where they are now. And they said it again at the June meeting, 2.8 instead of 2.6, because Jerome Powell said he needs to see more than inflation's come down. Inflation went below 3% by all the measures they like to look at, and prices did not go down, right? Inflation is just lower than it was, went from 9 to below 3. Well, the Volcker thesis from the 1970s. Volcker took over after the inflationary 70s. Reagan cut regulation. Volcker said if we want the inflation rate to come down, we've also, in addition to cutting regulation, we've actually got to put the Fed funds rate right where inflation is. And they did it. And it was painful. It was a huge tightening cycle, one of the historic tightening cycles. Well, sure enough, inflation comes down. Volcker thesis says put the Fed funds, overnight bank lending rate, and cash rates right where inflation is, and it'll come down. Well, by their own definition, they're nearly 3% too high right now because inflation is below 3 and they're sitting above 5, so they're about 2.5% too high. How's the economy doing? Fed projections 2% over the next 3 years. Oh, unemployment rate, a nice low 4%. You know, usually 1 in 25 people have told their boss to take a hike and they're in transition. And PCE inflation, this is how they measure it. They're saying it's, you know, just below 3% on its way to 2, which is their target. So things are okay. Well, this was the key projection. It's not whether they cut September 18th or the next meeting or they delayed it when they didn't do it in June. No, they're going down. Well, let's look at something important here. When we take the Dow last month, the month began with a huge downdraft and everybody screaming recession. It was a delevering over in Japan. Where are we now? The Dow's back to 41,000, right about where it started the month. And everybody was getting off track for that. If you've been looking at 3 years instead of 3 minutes and you know what you own, great assets, then that was a little buying opportunity back here. And we did some of that on that Monday when the Dow was down 1,000 points. I'm Spencer McGowan, your financial weatherman, president, McGowan Group Wealth Management. Now, for strategy, McGowan Group Wealth Management serving affluent families right here from the Crescent in Dallas. This is the kind of team you want on your side. Why? Well, look at those Fed projections. We were looking at those back in March, and we said it doesn't matter whether they delay the cut or cut next meeting. They're going to cut basically every other meeting for 3 years. What does that do to the value of assets? Here's the tightening cycle. So this goes all the way back to 2005. We'll do that in a second, but look right here. Okay, so they put the rates at 0 because of the pandemic, everybody's going to die, and they're worried about bankruptcies, and they, printed lots of money. Now, they said, oh, we caused inflation. Not to mention the overregulation that corresponds to that, but here we go, all right? So this is the rate going from near 0 to 5.5%. Wow, that's tight. And there's the bear market. The NASDAQ was down by 1/3 in 2022. Ouch. And then it's pretty clear they're going to cut rates, right? Now they're actually going to start to do it. Now, this was the crash of 2008. They cut rates because all the banks were broke from being over-levered, and they did it way too late. But anyway, once they started to cut, things got better. This is where they raised rates. 2018, they caused a bear market cycle. That was a 20% drop in the S&P. And then they said, we're done. And it resumed, and they went down a little bit, and then we had the pandemic. Why is this important? The next 3 years, you've got the damage that was done here to valuations because cash rates were so high. Why take the risk, right? They're going to take that away. That's trillions of dollars looking for something with cash flow. McGowan Group Wealth Management portfolios, cash flow. And in many cases, they cash flow above 5%. Well, that might become more valuable. Relative net present value of future cash flow goes up when your discount rate goes down. It's an equation, but we'll cover more about that later. How has the whole market done over the past 1 year? So go back to August of 23. Now remember, we had at Halloween, we had a little meltdown. It was kind of the final meltdown, kind of a hangover from the 2022 bear market. But 21% on the Dow over the past year. The NASDAQ, 31%, thanks mostly to NVIDIA and the AI mania. And then S&P 500 up 28%. So that's the real score over the past year. That was a bull market you didn't want to miss. And how would you have not missed it? By putting great assets into the portfolio as the Fed tightened and stuff got cheap in retrospect. Are the earnings justifying it? Earnings year over year. So if I take the earnings for the S&P 500 companies, 477 of them have reported, the blue chips, out of 500. So we pretty much know this number is spot on. 9.37% is the year over year earnings growth. But wait, there's more. Look at this. This is double-digit profit growth projected for the next 3 quarters. And at the same time, so that makes the company more valuable, same time, Federal Reserve is taking down that excessively high Fed funds rate. That's a wow. Oh, this one, here we go, Target. So Target had a big implosion right here. They have now turned the company around, and they had a big spike this week. But it was also good news. Now, revenue was up 3%. What is that not? It's not a recession. It's good news on the consumer. Target actually increased profit over last year by 43%. So that was a nice little spike, and it may reverse this ugly cycle that Target had. All right. Whoa, this one is bad. Okay, how do you avoid things like this? So, remember the pandemic, all right? Everybody gonna be in their house, and they're gonna sit on the bike, and they're gonna be on these videos with everybody else, and they're gonna have a great time, and Peloton's the wave of the future. There was a problem along here. Everybody got excited. So it goes from $25 to $171. Ooh, Peloton. And then they got subscriptions. And then the pandemic subsided, and everybody liked to go outside and be with their friends. Instead of sitting on their bike all by themselves with a little video screen. And whoa, how would you have avoided this kind of hype? Because their revenue's going way up in the pandemic. Everybody wants a bike. And wow, if you had looked at their financials, they were losing money. They even lost money in 2020. That was their best year ever, and they still couldn't make money. And here we go. So Peloton this week, they had a little spike. That was a 40% spike in value. They went from basically 3 to 5. We'll call it 40 or 50%. It looks tiny compared to 171, but what happened? They didn't say they were going to make money. They said, we're going to lose less. Don't buy money-losing companies. I'm Spencer McGowan. Thank you for tuning in. Hope you subscribe. And We serve affluent families right from the Crescent in Dallas. You can set your time for a brainstorming session at networthradio.com. Thank you for tuning in today to Net Worth Media. We also have Apple Podcast. Simply type in Net Worth Radio and boom, it'll hit your phone right then. If you also go to networthradio.com on a browser, you're going to be able to meet the team. You can see our performance track record, the model portfolios that go with today's broadcast. Also at networthradio.com, the Longer Play podcast is available there as well. We're grateful that you've tuned in. Remember, when we talk about a security, it doesn't make it a recommendation for your portfolio until we actually complete a written plan for you by Zoom or in office or simply a conference call. So you reach us at networthradio.com if you want to get that arranged. Market fluctuations and how to handle them. We build high cash flow portfolios, and past performance doesn't guarantee future results, so you do have to be ready for challenging markets. We can build more cash flow during challenging markets than we can when everybody's happy and everything's up, which is when we tend to raise tactical safety. Those allocation strategies are here at networthradio.com. Thank you for tuning in.